Good afternoon. This is Randy Menton, and I wanted to kind of walk you through some of this Media Moguls activity for the first month. And so, without further ado, I'll just go ahead and get started. What you're looking at here, this is Exhibit 2. And Exhibit 2, you have the chart of accounts and trial balance, and then you have over on the second page, you have your amortization schedule. And these are just numbers that I put in to calculate some of this stuff here. But essentially what you have is the opening trial balance. In this case, it comes down to $870,000. Now, that's not going to be what's on the balance sheet. So I want to be sure that you understand that this is just a trial balance. If I think about the balance sheet, remember that this number here, this accumulated depreciation, comes off the asset side. So you're going to wind up with the assets, whatever those assets total, 870,000 here, minus the 20,000 to get to that side. And it'll also mean that this side over here is going to be 850,000 because you won't have this number in it. Okay. So here's what I did. I went out to the web and found a I found a thing called Wave. And Wave, because I couldn't really do this the way that I wanted to do it in QuickBooks, because it was already something that that had been done in the past. And if I wanted to redo it, I was going to have to do it from scratch and go out and erase all the entries that I put in. It's going to be a real pain to do. So what I decided to do instead was to go out and see if I could find some free package that I could basically do the same thing with that QuickBooks does. And of course, it's a pretty big space. And for the most part, these things all have to work in similar fashion. Now, this one, as I walked through just the first part of it, I realized that it was not nearly as sophisticated as as QuickBooks is, but that's okay for this particular purpose. It's fine, and I'll just show you a little bit about what I've done um, in terms of chart of accounts. They have some expense accounts, for example, and they have some asset accounts that they already create for you. But I decided to go out because I wanted to assign some numbers to each one of these accounts. I decided to go out and create them on my own. Plus, in this particular package, it doesn't do a good job, according to the write-up. It doesn't do a good job of tracking accounts receivable, accounts payable kind of things. So what I did was I went out, and if you'll notice um, back over on the Media Moguls portion over here, there's only one account for accounts receivable. And it didn't have anything in it here, but there was only one account for it. So, whoops, I'm getting the wrong thing here. I got to get rid of this so it's not sitting up here down here. So anyway, so what I did was I went out and I just said, well, if they're going to do it that way, I'll just have several accounts receivable accounts, and I'll just assign them the same way that you really would be doing in the background. Because what's happening with its accounts payable or accounts receivable is you have these subsidiary ledgers where they take the accounts receivable for example, for Mary Contrary, and then they're going to combine it into the big 120 account. I don't know how this is going to show up when I finally put some numbers in here. I may see this one may have several different accounts receivable accounts, but that's okay with me. Um, for this small of a project, it doesn't really make any difference. But this is a way that I can keep track of them. And of course, the same thing would be true for the accounts payable. So what I did was I went out and I created some of these things, and others I didn't. So, for example, on the expenses side, since I use the expense um, since I'm going to use the interest expense, I just decided to let it be the one that they have. And I didn't do office supplies um, expense, but I did office supplies because remember that from an accounting perspective, these are assets until we use them up, and there's no indication given, at least at this point through the first chapter, that we use those supplies up. Um, Going on down, we have telephones, we have utilities, and there were several things that we had for the utilities. And typically, what I'm going to have is I'm going to have a water expense, I'm going to have a electricity expense, and so forth, so that I can keep track of all of these individually for purposes of looking at trends and all those sorts of things. But for this particular purpose, I thought, well, let's just get a kind of a general idea of how it works. So when we do water and all and electricity, we're going to put it all in this single account. Okay. Um, all right. So that's I'd left those expenses pretty much alone. I'm not going to do too much with those. On the income side, and this is what you should have done. If you haven't done it, you need to do it. I created, I think, 5 different accounts: 400, 401, 402, 3, and 4. And those were for all of the different streams of revenue because I wanted to very definitely keep all of those separated so that I can see how much I'm doing in billboard advertising revenue. So later on down the road, in my little company here, if I were going to concentrate on podcast advertising or radio advertising, whatever the case may be, I want to be able to keep those separate so I can judge whether or not the people that I hire are doing a good job in each one of those areas. I don't want just one big revenue account to hide it all in. On the liability side, I had to create several different ones here, and I did them through other short-term liabilities and other long-term liabilities. And basically, what you're looking at here are the mortgage note payable on the current side and on the non-current side. So because we're treating those differently on the chart of accounts, and if you come down here, you'll see that. You see that I've got the current side and I've got the non-current side on all these different ones. And that's mostly just so that you can see that in the accounting world, we look at things that are current assets and liabilities versus non-current assets and liabilities. And one of the requirements that you have is to give me a current ratio. And and maybe even an acid test. I don't remember whether we did the acid test ratio or not. I don't have any inventory. There probably wasn't any reason to do that. But we did want to do a current ratio calculation. And you can't do a current ratio calculation if you don't separate these liabilities by current and non-current. And of course, in the real world, that's the way that it happens anyway. So, so I separated them here as well. Now, I'm going to go back here to my transactions, and this one works, I think, probably pretty similarly to QuickBooks. It's, and I don't want to confuse you, but whether we use the only difference is going to be in the way that it's presented. Okay, you still have to be able to do journal entries and all that sort of thing. And so for the opening entry, what I did was a journal entry. And so, and again, this one works actually quite differently than the one in QuickBooks in terms of the way that you set it up. So if you wanted this to be a credit, for example, you could simply click this little button over here, and it would put it over on the credit side, which in this case would put it out of balance. Now, if you notice here, you've got $870,000, which is the same number. So I come down here, that's that number. Okay. So how did I set it up? Well, I just went through and I had to create all these accounts up front. I created a land account under the asset, property, plant, and equipment side. And so let me go back up here and um, so you can see that was under your chart of accounts. And I went down to the, oops, that's the liability side. I want the asset side. I came down here and I created all of these property, plant, and equipment things, the accumulated depreciation for the vehicles and the office equipment, furniture, buildings, and so forth. And here's your land account, okay? And I created all of that based upon, again, based strictly upon what you saw over here for the Media Mogul stuff. So if it was a 140 here for land, it's a 140 over there for land as well. Okay, so go back to this. Let's go back to the transaction itself. This is the transaction. And what I did was I just went through and I picked up the numbers that were on the chart on the trial balance because this is your opening entry. And so I went down through here and the land is 200,000, vehicles is 50,000. And I just put all of this stuff in. There's a 20,000 credit for accumulated depreciation. So notice it pops up over here. Office equipment, office furniture, and these are the assets, right? And now here are the liability side. And if I come down here and I look, I have total debits of 870,000 and total credits of 870,000. So I'm pretty sure that I have picked up everything correctly from this guy right here, the trial balance that comes to 870,000. Okay, so that's all you're doing is you're just creating an entry. So if it's a debit here, it's going to be a debit there. If it's a credit here, it's going to be a credit there. Quite simple. Okay, now let's take a look at reports in this case, and you're going to have reports over on your side as well. Here they have 3 different reports that they're giving you: cash flow, balance sheet, and profit and loss. Well, you haven't recorded any entries yet. So you don't have any profit and loss. All you have is a balance sheet. And so if I pop on the balance sheet and I look at it, this tells me what my cash and bank is for whatever reason. This is to be paid out, so it's just giving me the amount of cash that I have available based upon what I'm showing here. This total to be paid out, those are all your short-term liabilities that you had on your trial balance. And so notice now that the assets have changed. They're not 870 as you saw in your trial balance. They're not, the debit side is not any longer 870, it's 850 because I had to subtract on the asset side the accumulated, excuse me, the accumulated depreciation. Now, this is one thing, just looking at this particular little software package that was free, so I can't complain too much. But if you'll notice here, I've got my liability side, here the total current, and this is going to equal this guy right here, by the way. And here are the longer term liabilities. What they don't do is they actually don't add these two together in terms of total liabilities and equity, which is what you would see on a balance sheet. But you can just see 435 plus 415 is going to be equal to 850. So that's how you get to your opening trial balance and your opening balance sheet. And if you don't have those numbers to start with, you're going to be wrong from the very beginning. So make sure you have that. So at this point, I'm going to close this one out and post it.